I think it stopped sharing now.
Yeah, I only stopped it. You
Okay.
can just. Yeah, you can see the screen now, right?
Yes. Yes.
So let me know when to start.
Yeah. I mean, we'll start in another 1 minute or rather.
All right.
I think two people have joined. Let's start now. I'll just yeah.
Only two people.
Hi. Yeah. For now, I think the people usually start coming 2-3 minutes into
Okay.
it. So anyway, let's start off. Good morning, everyone. Thank you for joining us today on a Saturday morning on our webinar, the Investment Odyssey, with Mr. Darshan Engineer, Fund Manager of Sundaram Alternates. We'll start in another 2 to 3 minutes. We'll have some more participants coming in. So let's start by 11:03 to 11:04 types. So thank you all for your patience as well. Thank you. I think we can start off. Ramya, all good, right? We can start off right now, right?
Yes, sir. All good. We can start.
Thank you. Thank you. Thank you all for joining us today on a Saturday morning. And welcome to the Investment Odyssey, a webinar by FPS Assets. And today we have Mr. Darshan Engineer, the fund manager of Sundaram Alternates. See, Sundaram Alternates has goes a long way back, right? It's a household name for all of us. So in the last 1 year, their equity funds have been making waves in terms of what they deliver to the investment guys table, and that's what is something that we've covered extensively in our document, which is published on a monthly basis called the PMS Chronicle, which we will be glad to share with you after this meeting. And that's where we've spotted Sundaram silently making these waves, right, in terms of performance. So today's context, Mr. Darshan Engineer, he comes with over 15, 16 years of experience in the equity markets, with his experience spanning over firms like ValueQuest, Karma Capital, and where he did a lot of bottom-up investing in the small and mid-cap segment, where he extensively worked on the fundamental principles of investing through a bottom-up approach. where specifically he focused on sectors like auto ancillaries, pharma, etc., and chemicals as well. So today, we invited Darshan to our platform to give us a view on how Sundaram is looking at the equity markets today, a bit of macros, and where Sundaram is placing itself in the product line with respect to equity markets today. Over to you, Darshan. Thank you so much for joining us today.
Thanks, Ganesh, and thanks, FTS Assets team, for inviting me on Saturday morning to take us through how Sundaram Alternates has been performing over the past few years. Let me start with a brief bit on how we are looking at the equity markets right now, and it's a very interesting but very volatile market as well. So let me jump right through, and I'll try to see. I will try to uh, be fast in certain parts of the presentation, and maybe I will delve more into certain other parts of the presentation where I feel it is more important and critical. So the first is that we are going to split our presentation into multiple different topics. So first is a bit on macro, which is again very volatile and constantly taking a 180-degree turn all the time. Second is, of course, the earnings trajectory. Basically from macro to the micro, where it is giving us or hinting at a totally different picture. And then a bit on valuations, the FII versus DII debate, and generally how markets are always volatile, and therefore, how to look at that volatility. And then, of course, we have always called out that the future returns are more from stocks outside of the indices, and thereafter a bit at how Sundaram tries to manage portfolios and funds. So first on the macro, as you have seen that till 2000 February 2026, our macro picture was looking quite good. I mean, things were improving on multiple dimensions. So, for example, the government had been taking some long pending reforms, specifically GST rate cuts. Thereafter, despite those rate cuts, GST collections have bounced back and have touched almost new highs again. So, which indicates that despite the cuts, GST collections are strong, and which indicates some improvement in the economy. And the bank credit growth, which is a barometer of the of the economic performance, it is at a 3-year high and close to 17 to 18%, which again indicates that at a economic level, things were looking quite in the heading in the right direction. But then what happened, of course, was that in March 2026, we saw a war emerge between US and Iran and Israel. And obviously, because of the geopolitical scenario, multiple commodities, specifically Brent crude oil prices, shot up all the way up to 120 $120 per barrel. And apart from not just the price increase, we also saw a variety of disruptions. For example, supply side disruptions, hike in logistics cost, insurance cost, etc. What it all meant was that, from our point of view, because we import a lot of these commodities, gold, crude oil prices, crude oil, fertilizers, we saw a sharp deterioration in our macro indicators, specifically current account and balance of payment. So obviously it puts pressure on the rupee, and therefore the rupee depreciated all the way to, I think, 97. And in between there was some improvement, but nevertheless I think things have again deteriorated. And because of this higher raw material prices as well as the rupee depreciation, what happens is that we have to go through another round of high inflation, which possibly means that we may be at the cusp of a new rate hike cycle as well. If global factors were not enough, I think this year we are also staring at a risk of a below normal monsoons. And therefore, what happens is that in that case, even the agri side of the economy can suffer. Fortunately, in recent years, what we have seen is that the rural economy is no longer just dependent on agriculture. They have a variety of other allied businesses or unrelated businesses, each one of them, which helps them to, I would say, reduce the pressure from a poor monsoon. And hopefully, monsoons, now that they have picked up in July, hopefully we may not be staring at that big a risk for this current season. But nevertheless, this risk remains. At the same time, what we are also observing is that various high frequency indicators are quite healthy despite the war. For example, the two wheeler and the passenger vehicle sales have been very robust. In fact, a few days ago, TVS Motors and Bajaj Auto came out with a very good set of numbers, both on the domestic side and the export side. And therefore, I think things may not be as bad as what at least the macro picture indicates. Similarly, if you observe, real estate registrations have been quite healthy. You may say that some parts of the real estate is not doing well. Obviously, that would be the case because not everything moves in sync. But generally, high frequency indicators are indicating that things are not as bad as they were made out to be at the beginning of the war. Uh, Now let's come to the micro. When I say micro, I'm referring to corporate earnings. Now, I mean, here you need to understand what has been happening in the Indian corporate diaspora. Uh, for a very long time, we saw that Indian corporates were not seeing strong growth in earnings. The period from FY20, FY12 to almost FY20 was a period of very slow earnings growth. This is the Nifty EPS earnings. You can see in FY12 it was at around uh, 300 odd rupees, and now in FY20 it was only at around 500 odd rupees. So therefore a very slow earnings growth period. But this period was also marked by a certain other factors, which therefore, from an equity market point of view, we still enjoyed decent years of good performance and good market returns. I will come to that later on. But from FY21 to FY24 was a period of sharp earnings growth on a low base of because of COVID. So from around 500 rupees of EPS, we jumped all the way to almost 1000 rupees of EPS by end of FY24. And this was the period where, I mean, we saw a very strong bull market in India, especially in small and mid caps. And Therefore, I mean, in September 2024, I think we reached the peak of the market. And from there, we have been struggling to cross those highs. Uh, the reasons are simple. I mean, there was a valuation fraud that built up, as well as, I mean, it was also after this that we saw entered another period of slow earnings growth where from 1000 rupees it was only around 1100 rupees by FY26 end. So therefore, I mean, we have been going through a slow earnings growth again after a rapid phase for the in between. And the expectation is that, I mean, we are entering the new leg of stronger earnings growth. However, it's still at an infancy, and we have to see whether and how long and durable this high earnings growth phase will be. From our point of view, I mean, the slowdown in earnings growth was persistent. Every quarter, we would see consensus estimates getting slashed by various sell-side brokerages. But starting from Q2 FY26, we started to see the first signs of low earnings cut or no more earnings downgrade, if I were to put it that way. That became stronger in Q3 and Q4 FY26, where Q3 was the first quarter where we saw a broad-based earnings growth across multiple sectors, across market caps, with the mid and small caps growing faster than the large caps. And I would say this was also because of the GST rate cut, which drove a lot of pent-up demand in multiple consumer-oriented sectors like auto ancillary, consumer durables, etc. And Q4, interestingly, despite the 1 month impact of the war in March, still delivered a decent earnings season. And there were some idiosyncratic factors also. For example, I mean, there were some sectors which benefited from the high raw material prices, and because they were able to pass it on to consumers, and therefore, despite low volume growth, their value growth was very strong. In some cases, the January and February were very good for certain sectors, which covered up for some shortfall in March, and therefore, I mean, on average, Q4 was still a very good earnings growth season. And despite the war, despite the potential earnings cut in FY27, the EPS CAGR from FY26 to FY28 has still been maintained at around 15-16% post Q3 result season and post Q4 result season also, which indicates that basically, I mean, despite all the negative macro news flow that we are seeing, at an individual corporate level, companies have been able to navigate the challenges and are still able to report good earnings growth as well as give good promising outlooks for the next few years. Uh, And therefore, I mean, as you can see, I mean, despite the war, I mean, FY27 EPS estimates have not seen much of cuts. So, for example, if you see here, starting from around here, the earnings cut have not been significantly changed. Similarly, this is the estimate for MSCI India index. So, even that has not seen much of cut, but it has been generally flat, which indicates that there is some resiliency in the economy, and generally a good demand scenario is being seen everywhere. And interestingly, there are sectors which benefit from high inflation, and therefore, uh, it is quite possible that in a high inflation scenario, there are sectors which will do well, and therefore, interestingly, stocks which benefit from high inflation, or interestingly from a deficit monsoon, their share is now higher in the indices versus what they used to be earlier. So, interestingly, while the macro may look negative, at a micro picture level, interestingly, earnings growth may even accelerate going ahead. And therefore, I mean, markets are a slave of earnings growth. And therefore, if earnings growth pick up despite all the negative news flow, we may interestingly see even positive return in the equity market if we have slightly longer term view. Coming to the valuations aspect, I think, as you can see, I mean, the Indian market valuation multiples have steadily moved up over the past 15 years. And this is what I was referring to earlier, that, I mean, from FY12 to FY20, despite a lackluster earnings growth profile, we saw the markets delivering good returns. And the reason for that was that, I mean, the Indian equity markets valuation multiples moved up steadily from 14, 15 PE to today it is at 2021 PE, but it has been a gradual rise. There are multiple factors for this. First is that, I mean, Indian market has seen a steady decline in the cost of capital. So from what used to be an 8, 9 to 10% inflation rate and 8 to 9% bond yields, today is at around 5 to 6% inflation rate, or 4 to 6% inflation band, and the cost of funds is down to between say 6 to 7%, despite the volatility that the cost of capital also goes through. But because of the structural decline in the cost of capital over multiple years, it has an inverse effect on the equity market multiple. So lower cost of capital means higher PE multiples. Even apart from that, what we have also seen is that, I mean, there are other factors such as, for example, uh, the nature of the index itself has changed, in the sense that earlier the indices were composed more of old economy, capital intensive, strong, big balance sheet based companies, which traditionally have low return ratios and therefore low PE multiples. Whereas the indices now consist more of asset like companies, good return ratio profile companies, and therefore, I mean, generally have higher PE multiples also. And then there's, of course, the third impact of the flows. I will talk about the third aspect later on. But I mean, considering the last 2 years where markets have not delivered any returns at an index level, what we are observing is that the valuation multiples have corrected quite a bit. So therefore, as you can see, the valuation multiples, despite all the earnings cut and everything, they have derated to an extent and are now more reasonable than earlier levels. I'm not saying that the market is cheap, but at least it is becoming more reasonable. Coming to other indices, so for example, we had a top of the market in September 2024. If you notice, this was the time when the valuation multiples had become very rich, especially mid cap and small caps. They were near their all-time highs in terms of valuation multiples. And from there, we have seen that they have all derated. The large cap, mid cap, and even the small caps all have seen some derating, and which is why, I mean, as you can see here, another way to look at it, in September 2024, valuation multiples of various indices were at their highs, and they have now all corrected quite a bit from their highs. So, valuation reset plus an earnings growth that is coming through. And I mean, despite the near term deterioration in macro again, uh, hopefully, as and when crude prices again cool off and macro starts recovering, we are going to see a good compounding potential from our market point of view. Particularly, I think small and mid caps is the place to be in versus the large caps. The reason is simple: the small and mid caps generally tend to grow faster than the large caps. As you can see here, based on certain sell side estimates, the large caps are expected to grow at around 10 to 15% CAGR, but the mid cap and the small caps are expected to grow much faster at say 20 to 30% CAGR. And therefore, I mean, it makes sense to be more on mid and small caps versus the large caps. Because there are many parts of the large cap indices also, particularly in sectors like FMCG, large cap IT services, oil and gas, where earnings growth is not as strong as what they used to deliver earlier. We are not saying that large caps are not a place to invest in. We have certain allocations to large cap also, but generally, our portfolios are aligned more to mid and small caps versus the large caps. And as you can see, I mean, the share of small and mid caps in the total market cap has risen to all-time highs as well, and the large caps have corrected. I mean, as a share, have reduced significantly. Now I'll come to the third aspect as to why valuation multiples have shot up in recent years is also because of the strong DII flows. We have seen that DIIs have been net buyers both on monthly level and on a yearly level, whereas FIs have seen consistent negative outflows over the last few years. The reason is simple. I mean, DIIs, especially after COVID, I mean, as more people understand the long-term power of equity investing, more people have started to put faith in the Indian market and have participated through SIPs or lump sum investments. And therefore, I mean, because there is such a strong flow, and because it is mainly through mutual funds and other means, they generally chase the top 1,000 companies in the market. And therefore, what a company, when it used to trade at 15-20 p multiple 1 year forward, today would be trading at 25 to 30 p or even higher. So therefore, I mean, because they all of them are chasing the same set of companies because of liquidity or other factors, there is no option but to buy even at higher prices, and in the process the valuation multiples are kept on moving up. Today, DIs are the second largest owner of the Indian market after promoters, and FIs have become the third largest. And therefore, I always tell that, I mean, DIs are more important to India, not FIs. This is two interesting data points. One is that, I mean, if you see, the NAV of an equity-oriented mutual fund has seen almost a 2 year time correction, and I mean, basically average investor in Indian market has not made money over the past 2 years. Especially the ones who have been doing SIP, their 1 year SIP returns I think would be flat or negative right now, and that is why, I mean, they are very important because their patience is now being tested. If for some reason, if the domestic investors lose faith in the Indian market and they start doing redemptions, then we are staring at a vicious cycle where, I mean, more and more redemptions lead to more and more sell off despite generally a good macro environment or a good corporate earnings growth environment. And therefore we may see a de-rating in the Indian market also. Therefore I always suggest that, I mean, we need to ensure that the DIs continue to retain faith and keep investing in the Indian market and not much into the, I mean, not worry too much about FIs. Any which ways, FIIs have a long, I mean, multiple options to invest. So it's not as if they only have to come to India. They have multiple other markets. This is data shows that, I mean, there are various other markets which are growing at better earnings growth versus Indian market and are available cheaper versus the Indian market also. So therefore, I mean, it makes no sense for them to invest, say, in India, or I mean, have an overweight stance on India. They can very well go into other markets, make money in those various other markets, and thereafter come back to India when our markets turn to cool off, and if they find some good opportunity in the Indian market. It's not as if FIs have completely gone away. They have also, they are, I mean, they are smart investors, so therefore they also realize that better returns are better returns potential is more in mid and small cap, which is why if you see here, I mean, from an FII point of view, uh, even they have been investing more in the small and mid cap space. I don't have that chart with me here, but I mean, FIIs have also been moving more towards mid and small caps versus the large caps within the Indian market. This shows you that, I mean, other markets have generally delivered good returns on multiple time periods versus Indian market. So look at the Korean and the Taiwanese market. Of course, a lot of this return is influenced by the recent strong returns that we have seen in the last 1 or 2 years. But even nevertheless, I mean, there are multiple opportunities out there as well. Uh, you can also say that, I mean, India was such a strong return generator for the FIIs over the past 5 7 years, that I mean, in recent years they have used India as a cash cow. They have been selling from Indian market to generate cash and deploy it in other markets where they saw better opportunities. At the same time, there is of course this phenomenon of AI theme, where I think India is considered as a company which doesn't have any substantial AI related investment ideas, and therefore people have generally been underweight India and have put more money in countries and sectors which have AI related uh, tailwinds. So the primary beneficiaries in recent years have been Korea, Taiwan, I would say to an extent Japan, and of course the US market. So that is one reason why India has not seen that stronger flows in FIIs. But at some point, I think people are figuring out that, I mean, not everything is good and clean, hunky dory in AI world, and therefore, I mean, in for example, in July, we have seen that FIIs have been net positive versus negative till date. But what also happens is that because of this adverse macro environment, I mean, rupee depreciates, and rupee depreciation is again one more negative for FI. So their returns are in dollar, and if they are not able to see any return in dollar or negative return, that also is a one more headwind for FIs to make a comeback. From domestic investors' point of view, I mean, INR depreciation is not necessarily negative. From a domestic equity investor point of view, I mean, it depends on the nature and the seriousness of the INR depreciation. In the past, what we have seen is that every INR depreciation, sharp depreciation, has been actually a benefit to the domestic equity investor eventually. If you had, I would say, 12 to 24 month view. So every time the rupee depreciated by these kind of percentages, net net we have seen a good equity return for the domestic investor. So therefore, I would not be too perturbed about the current rupee depreciation that is going on, because it will eventually lead to a very strong equity return profile if we stay invested. And therefore, I mean, as I told you, I mean, a negative macro but a positive micro, and a reasonable valuation band implies that, I mean, the market is ripe for good return profile. But at the same time, we have to understand that, I mean, equity markets are not linear; they are volatile, and I mean, especially this decade is a volatility on steroids. So. We have seen that there have been every year there has been some big disruption event that has taken place, and which has had some uh, long lasting impacts on multiple dimensions, I would say geopolitical, economic, climate, or technology. And each of them, each such crisis has been like uh, arrived faster, it has hit harder, and I mean, it has created even bigger ripple effects. So, I mean, for example, recently we have, I mean, I call it as the VUCA word. VUCA basically stands for volatile, uncertain, complex, ambiguous. All jazzy words, but trying to indicate the same thing, that it's not easy out there, especially from an investor's point of view. Multiple things going on, so many news because of social media, a lot of news flow, and all of them get absorbed very quickly and within seconds, I would say, with the rise of algorithmic investing and machines. So, lot of things going on at the same time. From our point of view, I mean, there are some additional risks that we need to be aware of. I think nobody really thinks about it, but they are out there and they can potentially have negative consequences for the Indian market in the long term. One is, of course, AI, which is impacting the white collar workforce of India across industries, including mainly the IT services, but I would say it would impact even legal, other business process outsourcing services, financial accounting, etc. Of course, there is the threat of automation. We have started to see the implementation of robots, and I'm not talking about the simple robots like that what ABB supplies. I'm talking about humanoid robots being put in use in factories in China and in US now. So therefore, I mean, they will not even complain about work hours or pay scales, wages, etc. So that is a big threat. From India's point of view, I mean, we are trying to increase share of manufacturing, but to no avail. And therefore, I mean, we are potentially staring at a demographic disaster. Hopefully, it doesn't happen. But I mean, these are just some risks I'm trying to highlight. So basically, every year, I mean, markets are volatile. There are months when markets go down, and months when markets do well. On many years, their returns have generally been positive annually, say either on a calendar year basis or on a financial year basis. But within that same year, there would be sharp drawdowns to the extent of 20-30% also. So in fact, what I'm trying to highlight is that I mean we should not be too worried about such volatilities. In fact, use them to the advantage to build positions if you have a long term view, because eventually, I mean, every such prolonged correction has eventually led to a very sharp and longer recovery. So I mean, if you recollect, in February 2018 the government introduced long term capital gains for the first time, and what it led to was a 2 year underperformance, especially in small and mid caps, where they corrected significantly from their highs. It was as if, when would this correction get over? It got over in end of COVID, but after the COVID bottom, we saw a very sharp multi-year recovery, and I mean the small and mid caps led the rally, and we had a very strong, I mean, multi-bagger kind of return in the indices itself. So you can imagine the multi-bagger returns that many investors made in many small caps, micro caps, mid caps also, which were even higher. So now we are in one such phase where I mean, for the past almost 2 years, we have not really seen any money being made in the markets. But what I would like to highlight is that every such 18 to 24-month period when we have not made money or the market has been sideways has generally been followed by a good 12-month and a good 36-month return, cumulative return I am referring to here. So I think we are on the cusp of similar kind of a recovery in the market. The initial such reactions have been confirmed, I would say. So this is another data point where I'm saying that I mean every time a war has come in the Indian, I mean war has happened anywhere in the world, Indian market tends to correct by 10 to 15%. That is, happens in the immediate month of the war. But in the next 1 month, 3 month, and 6 months, generally market returns are quite positive. So we are seeing the same thing happening. I mean, we fell by around 11-12% at an indices level in March. But then we saw a strong recovery in April, and then on a 3 month basis, again we are net positive. July we are again slightly flat, but I mean now we'll have to wait for another 3 months to see how the 6 month happens. And obviously, I mean, the other point that I wish to highlight is that I mean, long term orientation is very important. So, even if you enter at the worst time, by worst, I mean you enter at the top of the market. Even if you do that, but if you have been generally more than 5 years invested in that indices or a strategy and all of that, you generally tend to make a positive CAGR return even in the worst case. Obviously, with active fund management, this can improve towards this kind of situation. So, longer term orientation to equities definitely helps because it evens out the volatility that you see in the short term. And we have been through such brutal corrections in recent times. So, for example, till a while back, large caps were not falling much. It was the small caps and maybe to an extent mid caps which were falling more. But then after March, what we have seen is that small caps have made a strong comeback. Mid caps have always been much stronger than the large caps. But large caps have went on to remain range bound. But it is the small caps and the mid caps which have done much better. So what I am trying to highlight is that I mean it's not as if the market is only about indices. I mean there are several sectors out there which are doing well despite the negative macro and all of that. I would say India. I mean, people are nowadays want to invest outside of India, but what I would highlight is that I mean, every market outside of India generally tends to be dominated by one or two sectors. For example, Taiwan is mainly TSMC. Korea is mainly two companies, Samsung and SK Hynix. These are all companies which are related to semiconductor and AI, but outside of them, they don't really have many companies which are investable and which really are diversified in terms of sector. Whereas India has thousands of companies. In fact, BSE has more than 6,000 companies listed. NSE has, I think, 3 4,000 companies listed. and the number of companies getting listed or being listed are only increasing every year with IPOs and corporate actions, demergers, etc. So, I mean, India is blessed to have so many companies, sectors across market caps, across sectors, and all of them are doing some reasonably good job in terms of their sectors, growing well. I mean, trying to find new avenues of growth, trying to expand their total addressable market, and so on. So, despite the flat index return over the past 2 years, many sectors have done well in the recent quarters and months. So, in every bear market there will be sectors which will be doing well. Similarly, in every bull market there will be sectors which will be struggling. So therefore it is the job of fund managers to be actively invested and try and see if we can be more oriented to sectors that are expected to do well over the next few years. And therefore, I mean, you can always find names and companies that will do well irrespective of the market condition, which is what we have been trying to do at Sundaram. So now I will take you through what Sundaram has been doing in the last 2 years, I would say. And these is just the framework that I am highlighting. One is that we are mid and small cap oriented investors. So all our strategies on the alternate side is basically dominated by mid and small caps. We have four strategies. One of them is a flexi cap and has around 30-35% allocation to large cap. So we are selective in large caps, but we are not avoiding large caps. In terms of investment framework, we are combination of top down and bottom up. So we identify certain top down themes which we expect to do well over the next few years, and then go about doing bottom up stock selection on those themes. In terms of the stock selection, we use three filters to shortlist our companies. One is that we want growth oriented companies, so we are not here to try and see can we get a good turnaround candidate at good valuation. No, we want good growth companies. We don't mind paying slightly higher P multiples for that because we are playing them for the earnings growth compounding. In terms of quality, we look at three ways: quality of business, quality of management, and quality of financial. So, for us, all three are interrelated. It's a combination of subjective and objective, quantitative and qualitative aspects to finally figure out if the company is fitting our quality benchmarks. And the final aspect is that of valuation. So after doing everything, say top down, bottom up, growth, quality, other checks, forensic analysis, etc. If everything is right, then we check the valuations, and if valuations are very rich for the company, then it becomes a part of the universe, but not a part of the portfolio. Some other aspects related to portfolio construction. So before that, I will just highlight a few other things, especially when it comes to the PMS side. We don't do a bullet investing approach, so we deploy it over 2 months generally. We start with around 40 to 50% allocation and then spread out our balanced deployment over 2 months so that we can get opportunities to buy during corrective phases also. We don't run a model portfolio as far as PMS is concerned. We generally have some common stocks across all investors, but there will be differences in stocks between new clients and old clients depending upon valuation multiples and so on. So, for example, we have benefited from our overweight exposure to capital goods in recent times. Now, obviously, they have run up a lot. Valuations are very rich. Therefore, we are very cautious for new clients. We don't buy it in the same proportion as it is for the old clients. The old clients, they benefited from low valuation multiples as well as strong earnings growth, which is why their weights secularly increased from say around 3 to 4, 5% individual weights. They many of them moved up to between 8 to 10% weight. So, starting in late May, June, July, we have been actively trimming it for old clients. For new clients, we have not been buying at 8-10% kind of weight. We have been only buying between 2 to 4% weight, depending upon the price and valuation. So, uh, because we remain positive on the long term potential of these companies, that's why they still form a part of new clients, but the weights are drastically lower than what they used to be. So, and we don't take aggressive cash calls. So we generally don't use macro events to generate cash. We basically trim our positions from time to time in our winners. At the same time, if we have not been right on a stock, we don't mind taking those losses also. and therefore, if required, we exit even at a loss in certain companies, and therefore, we have been able to uh, generate cash. So, cash call is more of an individual stock specific reason. For example, in March, we did not aggressively generate cash just because there was a war going on. There are reasons for this. I mean, when we don't know when the market can turn around from such a negative event, and therefore, I mean, we have more confidence on our individual companies that they may fall in line with the market or slightly more, but when the market recovers, they will do much better than the market. And this is precisely what happened. We are generally in line with the market fall in March, but then we had a great April month. We were up around 20 to 22% in all our strategies versus the benchmark, which was up 11%. And that is one of the reasons why our recent returns look very strong. So this is the investment framework that I was talking about, that we do a top-down thematic identification of certain sectors, company, sub-themes that we think will do well. Then we do the bottom-up stock selection through a three pronged approach, which is growth, quality, and valuations. And then finally, we build portfolios from the shortlisted companies where we start small. We create positions as small as say 1%, and then over time, as conviction improves or when valuations become more reasonable, we increase the weight. Don't mind exiting where we are not comfortable with the company, or if we feel that the investment thesis has gone wrong. And generally, we are low churn, so we don't churn unless required. We continue to hold on to companies as long as possible, because uh, the longer you hold, especially in a good company, the better is the compounding effect. So this is one thing that I was talking about, that as we uh, have reduced the churn drastically in FY26, that has also led to meaningfully lower transaction cost and therefore lower short-term and capital gains tax. So, just a bit on the four strategies that we run. So, we have totally four strategies. CSOP is our largest strategy at around 1800 plus crores. Followed, it is a flexi cap strategy. It is basically consisting of companies that have been doing well and are expected to do well over the next several years. Valuations are not the key criteria here. So, your valuations can be rich, but the earnings growth resiliency is so strong, and I mean the quality of that company is so good that I mean we are quite confident that over 3 to 5 years they can still compound at 20% plus kind of a return. Voyager is an extension of CSOP, so it uses the approach of satellite. So the core stocks of CSOP along with some tactical allocations, they come in Voyager. It is again a flexi cap strategy around 450 crore AUM, then followed by Self, which is a mid and small cap oriented strategy. Again, the nature of companies is similar to that of CSOP, except that some unique companies more in mid and small cap, which may be not as liquid as possible for CSOP, find their way in Self. And then, of course, we have a dedicated small cap strategy called Rising Star. It is around 130 crores. Self is around 1000 crores. So all our strategies have been very long tenured strategies. All of them have been in the market since very long. Rising Star was the first strategy. It started in November 2009, followed by CSOP in Feb 2010 and Self in June 2010. And you can see the returns CAGR since inception has been quite healthy across all of them. And therefore, you can see that I mean they have been beating the benchmarks for quite a while, and at a healthy pace, I would say. Um, Generally, we run concentrated strategies. So CSOP has between 20 to CSOP and Self both have around 20 to 25 stocks, whereas Voyager and Rising Stars have between 25 to 30 stocks. In terms of market cap allocation, as I told you, I mean, we are mid and small cap oriented. So even our flexi cap, CSOP and Voyager is only around 30 to 35% large cap, whereas Self and Rising Star don't have any large cap allocation. The large cap allocation you see in Self is more because of some mid caps doing well and becoming large caps. But because they have been doing well, there is no intention to sell from the Self client the large cap name just because it has become a large cap. So that is actively we don't buy any new large caps in Self. That is how we should look at it. Similarly, in Rising Star, we obviously buy small caps. Some of them may become mid cap over time. So therefore, the approach is to actively scout new small cap ideas and populate it in Rising Star or Voyager. And if they do very well and everything, if the conviction is very high, then they may be a part of other strategies also. In terms of sectoral approach, currently capital goods is our heavyweight sector, but it's not as if we deliberately bought capital goods at 47%. We had bought, I would say, 7, 8 names in capital goods with a weight of between 3 to 5%. And therefore, the original allocation for the capital goods sector, say 1 year ago, was around 30 to 35%. Over time, because the companies did extremely well, the weights have increased to almost 45 to 50% across strategy. As I told you, we have been trimming from these positions because of the sharp run up and very rich valuations now on future numbers. So therefore, we have been trimming it down gradually. In contrast, we have been incrementally adding exposure to auto, BFSI, healthcare, selectively some consumer names, and so on. You can also see that we are not aggressive on cash call. So, generally we are between 3 to 5% cash across strategies. Uh, the overlap, obviously, it is possible that because we run 4 strategies and there are some high conviction names, they find a way across all strategies. As an example, we were very positive on certain, uh, I would say, engineering goods companies which were exporting outside of India, like namely TD Power and MTAR. Therefore, they form a part of all the 4 strategies, actually 3 strategies now because we exited in Voyager. But MTAR is a part of all strategies and it has been one of the best return generator for us. But you can also see that there is a rate, not significant overlap. CSOP and Voyager, as I told you, because Voyager is an extension of CSOP, it has an overlap between 75 to 80%. But between CSOP and SELF, it is generally around 50% overlap, and between CSOP and Rising Star, it is around 30% overlap. The idea is that, very high conviction stocks, especially if it is a small cap, will find its way in all strategies. Therefore, TD Power, MTAR are there in everywhere. The weights can be different. So, for example, at the peak, both MTAR and TD Power had almost 13-14% weight each in Rising Star, whereas MTAR was at around 8 to 10% weight in CSOP, and TD Power was at around 6 to 7% in CSOP. Uh, Sometimes we like a theme, but we may play it through 2 different companies. For example, we believe that if equity markets are going to do well in the coming 3 to 4 years, then capital market plays can do well. On further refinement, we felt that I think wealth distributors were a good way to play this theme, and therefore we have, for example, Motilal Oswal in our CSOP, Voyager, and Self because it is a mid cap, and we have Novama Wealth in our Rising Star strategy, which is a small cap. So sometimes it can be through 2 different companies, and sometimes it can be through um, common names as well. This is a bit on the performance of the various funds in the recent, as on June end. So you can see that generally all our strategies have been doing well over multiple time periods. Of course, our 1 year return looks definitely very good. But I would also wish to highlight that, this 1 year returns can be up and down based on the month. But therefore, the way to normalize it over longer time periods is the right approach to look at. And this is where I would say that we have generally been very consistent. And you can see here that the returns have been at around 18% plus CAGR in most strategies, including even I would say now starting in Rising Stars also, which is a pure small cap strategy and bound by a bit more volatility. So our idea is therefore to keep identifying good companies at right valuation multiples and populate the portfolios across strategies. We are also not into the monthly outperformance game. So while our numbers look very good here, what I also wish to highlight is that there will be months where our strategies may see some big underperformance also, because we may not always be in sectors which are doing well for a few months and all that. We do our own process, channel checks, we do our own due diligence, everything. So, and it takes time. Despite the advent of AI, therefore, we don't want to rush or take any shortcuts. Therefore, if we miss some idea, it's okay. We will wait patiently if it comes back to our buying range. But generally, therefore, I mean, we tend to be long-term patient investors. There can be months where we may underperform also. And despite that, I mean, we have seen this kind of performance. And this, I'm highlighting this because, I mean, we did have some tough years in between. I mean, if you see here, I mean, various strategies generally had a tough time between FY21 to FY24. Now, if you see here, I mean, we did give absolute good returns. You can see that all our strategies, CSOP, Self, Voyager, and even Rising Star had a great FY21. But I mean, it did underperform the benchmarks. In some of them underperformed the benchmarks in FY21, and then we had a tough time from FY22 to FY24, where I mean, despite delivering generally good absolute returns, we did underperform the benchmark. Now, this was a period when value and momentum did very well in the market, whereas I mean, our portfolio at that time was heavily tilted towards quality, and quality as a factor did not do well. We pivoted from this. So I joined Sundaram Alternates in June 2025, and the previous fund manager made changes to the portfolio. And therefore, I think starting in FY25, we saw the first signs of a good turnaround in the portfolios across. Except for Rising Star, I think all of them did have a decent FY25. Then, of course, when I have taken it over, I have carried on the good work done by the previous fund managers, also tweaked and improved the processes along with my colleagues, I would say. So it's not a one man effort. We have a proper research team that has done a lot of hard work, and along the entire team, I would say that, I mean, went about being very active in terms of buys and sales. Uh, so therefore, I mean, you can see that in FY26, the outperformance improved materially, and it continues into FY27. Again, I wish to highlight this monthly data because I mean, see, we have had a great run in the past, I would say almost 1 year, and now therefore the July is currently trending like December. I mean, we are underperforming the benchmarks, but I mean, again, we are not here to play those monthly outperformance game. We are here to build portfolios that deliver durable, consistent returns over long periods, and therefore every such fund will have a period 1 or 2 months in between where it will go through a transition. Like for example, right now, I mean, we have been booking profits in some of our capital goods name, and newer ideas as and when they are getting introduced will take their time to start delivering returns as well. In terms of our peer rankings, I mean, generally all our strategies, yes, are in the top 20, I would say. But in the respective categories, for example, CSOP and Voyager are a part of the multi-cap category. In that, CSOP and Voyager are in number 3 and 6 as on 1 year performance basis and on quartile 1. Similarly, Self is number 1 in the mid cap, and in quartile 1 in mid cap. Rising Star is again in the top 2, 3 in small cap and in quartile 1. More importantly, I wish to highlight that it's that I mean there has been a consistency in the longer term quartiles also. So if you can see, even on the longer term basis, ESOP and Voyager have been in quartile 1 generally, and similarly Self also has been in quartile 1. Rising Star had a tough time in the past, but is now picking up, and similarly it has also been in quartile 1 in the 1 year and the 2 year category. So I think I have given you a lot of insights. I think I took a bit more time as well, but I would be happy to take questions if there are any.
Uh, Thank you, Darshan. I think that was a pretty extensive presentation. You know, you start off with macros and then went into micros and then finally got into Sundaram's way of looking at things. So I think our viewers would have got a good view of what Sundaram is planning as well, or rather what Sundaram has been doing and what Sundaram has set out to do in the equity markets, right? So if you look at it, I just so the practice is we usually as asset allocators ourselves, right? We have questions on the respective fund or the respective thinking of the fund manager as well, so that we ask those questions from FPSSs before we move on to the viewers' questions. So I just have a couple of questions before we can
Yeah.
move on to this. So You had mentioned that generally the last 22 to 23 months, right? The crowd has been, or the market has been pretty tired. Broadly, market has not actually made returns, right? But again, that's not the same thing for, let's say, people who have been increasingly bottom up with their choice of funds as well. So we usually talk about bottom up investing within the fund, but then let's say today it becomes increasingly important for you to be bottom up with your choice of the fund as well, right? If you
Yeah.
could reiterate a little bit on how people need to look at funds from a bottom up perspective, right? So as advisors or as people who as people who have clients and who bring in portfolios and other schemes to our clients, we are always stressing to our clients to look at the long term and look at the inherent nature of how a fund performs rather than the historical returns. So in that context, if you can give a bit of a view of how our viewers need to be increasingly bottom up in their choice of funds or schemes before they get into a specific investment product.
Oh, I think you would be the expert in doing that due diligence of individual funds. But from my point of view, I can only tell you that I mean, you look at the process and the systems that the fund manager follows internally.
Right.
From our point of view, as I told you, we do this entire exercise before going about and forming a stock as a part of the portfolio. So I would say that, for example, in the last 3 4 months, because we followed our process and systems, we may have missed out on many winners of the last 3 months, 4 months also. So, but we
Correct.
don't want to compromise on our process and our system. So, every company that we, for example, I'm just giving you one example. Health and wellness is one theme that we like. Now, health and wellness is not just about US generics, but it is not just about US generics, domestic formulators. It is also about CDMO companies, hospitals, diagnostics, medical devices, etc. Now, you may have observed that except for some select bottom-up bases, most US generic companies have not seen significant growth and are facing pricing pressure challenges. Now, a few days ago, there was an announcement of potential doubling of tariffs, 100% tariffs, and after 2 years, and so on. And before that, the stocks have corrected quite a bit from the recent highs. Similarly, in there are CDMO companies which are, of course, doing very well, growing at very healthy rates. For example, Laurus came out with a great set of numbers yesterday. Acuitas Chemicals came out with a good set of numbers again. But from my point of view, yes, they are a part of my, you can say, universe. But at the current valuations, does it make sense for me to add it into the uh, portfolio? Not necessarily. Therefore, for me, it's a constant exercise to keep evaluating newer ideas, scrape the bottom part of the market to see if there are some interesting opportunities out there, or otherwise be patient and don't act in a hurry just because I have done so much of hard work at analyzing a company that
Yeah.
even at high prices I'm willing to buy. That doesn't make sense, right? So we follow our systems and process. We try and ensure that we don't compromise on that, don't take any shortcuts,
Yeah.
because it is especially in bull markets when you will tend to make more mistakes for the future.
Correct.
uh, I think we are at the start of a new bull cycle in the mid and small cap part of the market, and therefore, there may be a tendency to compromise, but that is what our job is, and therefore, any good fund manager should be doing that. We from our side are definitely trying to do that, and in the process, yes, we may miss out on many good names, but I think the market is also very gracious enough to keep giving us opportunities. Like, for example, the last few days have been again a corrective phase, and
Remarkable.
the stocks
Correct.
across sectors are starting to cool off, and including
Correct.
some of our stocks also. So, for
Yeah.
example, we own MTAR, TD Power. They have been a great return generator for us. Uh, you can say that we generated most of our returns from capital goods, but it is not the case. Yes, in terms of sheer absolute returns and in terms of percentage return, capital goods had the best were the best return generator. But after that, there was also healthcare companies. So we had Acuitas, we had Aster DM, Newland Laboratories, which have also done it very well. In BFSI, there were companies which have delivered very good returns for us. Credit Access Grameen, Ujjivan, Bajaj Finance, especially from the lows when we have picked it up. So but yes, they may not have delivered as great a return as say the capital goods. But end of the day, I always look at portfolio as a relay race of say 25 stocks. uh, in a relay race, generally there is a one, the first runner starts to generate that initial return, then it is picked up by the runner, whereas the first runner takes a breather, waits, and then the third runner, then the fourth runner, and then again it comes back to the first runner. So same
Got
way,
it.
a portfolio is also a relay race. There will be five, six stocks which will do a bulk of the heavy lifting for a period of time, but then it after they run up, it takes a breather. The next set of stocks which may have not done anything till that point in time pick up, and they start to deliver the return over 3 to 4 years. Hopefully, maybe 60-70% of that portfolio has delivered meaningful returns. Nobody can be 100% right. So therefore, I consider 60-65% as a good success ratio to look at, which I think we are currently able to meet. Of course, we would want to improve it and increase this also, but it's not easy. And therefore, I think any fund manager who generally follows processes, systems, does a decent job on uh, the stock picking and everything. And also one final thing which I think is very critical, which a lot of fund managers, I'm sure everybody does it, valuation discipline. We are trying to follow that religiously over here, and therefore I think that would have contributed to our strong returns in recent years.
Absolutely. Thank you. I think you've answered my question. I mean, to the viewers as well, that it's the thinking that matters, right? Again, whatever we display in terms of presentations need to come on to execution. I think that's where it matters a lot. And a good amount of that validation happens at the advisors end and as well as the clients end. So I think that's a good one. There's another question that I had when you had mentioned on the valuation multiples of India, essentially, Darshan. So, see, generally, we've always traded at a premium when compared to the world, right? And for the right reasons, because we are the fastest growing economy in the world. But then, let's say today, with the advent of AI, with respect to any new age technology that has come in, we've pretty much kind of, let's say, stayed a little back, or rather, we have not advanced even as well as certain emerging economies, right? So, in that context, do you think we still deserve that premium over the entire world? Obviously, we are growing at 7-8%. Let's say our nominal GDP grows at 10-11%. Also, we should be one of the fastest growing economies in the world, definitely. But then again, do we still deserve a valuation premium just for that aspect? Something on that.
Yeah, so see, very interesting question, and I would just highlight a few things. One is, see, you see this chart that I showed. So our P multiple used to be 15
Huh.
in 2010 to 2015. Then it moved to 17. Today it is at 2021. And the daily valuation moves has actually come to a discount, at least on the on versus the average. So
Correct.
if you see this, right now we are at around 18, 19 times. But do we really deserve at a nifty level to go back to 20? Maybe not. Who knows?
Hmm. Hmm.
The
Hmm. Hmm.
reason is simple. Our indices are mainly consisting of stocks which have been the winners of the past. And I
Hmm.
would like to point out, I mean, it's not as if something, I would say that I am the discoverer of it. There are some really good experts out there in the market who have correctly called out that, I mean, the indices are actually consisting of winners of the past. So let us take a breakup of the Nifty index at least, which is consisting of mainly the BFSI sector, 33%, including HDFC Bank, ICICI Bank, and some of the other banks and so on, Axis Bank and so on. Now, in that, because they have become so large, especially HDFC post its merger with the HDFC Limited group, that, I mean, unfortunately, because of that merger, now the growth rates structurally cannot be, you cannot really expect it to grow faster than the system. It's so
Correct.
big now. Nevertheless, I mean, at a valuation, maybe it makes sense. HDFC Bank, I'm just talking about it. But from a composition of the index level, I mean, BFSI large parts cannot grow at very high rates.
Hmm.
Okay. I mean,
Right.
of course, the banking system on a low base can see a period where it can grow at 15% earnings CAGR, which is what the
Hmm.
likes of say an ICICI Bank or Axis Bank are calling out, and even HDFC Bank for that matter, right?
Right.
SBI is there and all of them. So you can expect, say, the BFSI sector to grow at around 15% earnings CAGR for the next 2 3 years. Now let's come to the other aspect, which is IT sector, which is
Hmm.
TCS, Infosys, Wipro, and some maybe. Now there, what you have observed is that they are in fact a net, uh, not a beneficiary. They are going to be at a disadvantage because of the AI world, and we can see that. The other thing which is hindering that growth is the size. They
Hmm.
are all employing lakhs of IT engineers. Unfortunately, the world is moving away from a traditional employee into revenue per employee model, and it is going into a fixed price model. Now, in
Right.
a fixed price model, there is no constraint on how many employees you have to use. With the advent of AI, you can use lesser number of employees and take some LLM model and implement a project. So, therefore, what happens again is that, I mean, TCS, Infosys, Wipro, and some other companies cannot grow at double digits.
But
Maybe.
isn't that margin accretive for them as well if they are able to do that? That's
No,
the
I mean, in the short term, it will be margin negative also, possibly. I mean, it
ah
can be. I mean, I'm not saying that. But if your revenue only is not going to grow, in fact, will be negative, there is no use of
growth
margin
is
improvement, right?
understood.
So in the
Got it.
worst case, they may not see earnings growth or very low muted earnings growth. Then you have
Hmm.
the likes of ITC, Reliance, ONGC, Oil India, which again are a very volatile sectors. I mean, ITC in the best of times can grow at maybe a high single digit in top line because of the dominance
Correct.
of the spirits business. It has the good FMCG business which is growing, but the base is so small and the cigarettes business is so large by that it can't really showcase and again in earnings growth. So therefore, what I'm net saying is that the earnings growth profile of the Nifty, even in the best case, can be let's say between 10 to 15%. And
Hmm.
but I
Right.
mean, if you were to invest passively, like everybody calls that you invest in passive ETF and all,
Hmm.
but then I'm sure all of them would have been suffering from no returns in the last 2 years. That is
Correct.
because I mean, all these passive, I mean, all these indices stocks are not able to grow at healthy rates, uh,
Hmm.
and and even the future signs are not promising, right, in terms of
Hmm.
growth.
Yeah.
If you look at the US generics companies, Dr. Reddy, Sun Pharma, they are all, I mean, Dr. Reddy unfortunately is struggling for some specific reasons. Sun Pharma has had to use acquisitions as a way to grow, which will have its own set of not issues, but I would say, I mean, does lead to some sort of a drop, I mean, pullback on the earnings growth front because it has to take debt in order to acquire that large company organon and so on. So, multiple parts of the indices, especially at the large cap level, I mean, they all these companies became a part of the index because they did very well. But
Right.
now that they are a part of the index, the best phase is behind them. So,
Understood.
but the best phase of companies in India are the ones which are not in the indices or maybe are part of some small cap
Correct.
or mid cap indices. And they will take a
Correct.
very long time to reach the large cap indices. But by the
Correct.
time they become large cap indices, their base phase will be over. So generally, therefore, you should be investing beyond the indices or invest, say, outside of the index, or maybe more in the mid and small cap where you are having those sectors which are expected to do well. Which are the sectors expected to do well? One is, of course, the manufacturing space. I mean, it's
Yeah.
not just the capital goods; it's also chemical companies. It is engineering goods companies. It is auto ancillary companies which are moving away from auto and also diversifying into aerospace components or defense
Right.
components, right?
Right.
So, but they will never be. I mean, their size is currently small and prevents them from becoming a part of the industry. So, it is quite possible that from your valuation point of view, the large caps may again go back to a phase where they trade between 15 to 20 times, right?
Hmm. Got it.
So cannot. So therefore, again, you need to do a bottom up stock picking,
Yeah.
even in large caps.
Okay. Okay. Got it. So what you're essentially saying is, so let's say, if I'm an investor and I'm looking at index, I would much rather put my expectations in the context of, let's say, a nominal GDP, or I'm tracking the nominal GDP effectively. And the case for alternates, where the bottom up investing becomes the main case, right? Becomes because I don't have any benchmark hugging, or rather, I don't need to ideally prove my performance against the benchmarks on a consistent basis. So, in a way, we are getting more bottom up, where the case for alternates is becoming much bigger. Is That's what you're saying, right?
Absolutely.
Essentially. Got
Absolutely.
it.
In fact, so see, for variety of reasons, unfortunately, the mutual funds on the active side also are constrained, I would say, to
Ah,
really run very high active shares in their funds. Let me put
right,
it that way.
right.
I mean, there are funds which are taking that approach on the mutual fund side and doing a good job. I mean,
Yeah.
becoming very highly active fund manager. What do I mean by highly active fund managers? They would have a very high active share ratio, as high
Right.
as 80-90%. Basically, say somebody is running a large and mid cap fund, or somebody is running a mid cap fund for that matter,
Hmm.
but the
Right.
stocks in that portfolio, I'm talking about the mutual fund, can be totally different and not be there in the index, mid cap index or the large and mid cap index.
Correct.
Those I
Correct.
would say are the real active fund. It comes with its own set of risks also. I mean,
Right.
what if those stocks didn't do well? Then he will be under pressure from the team to revert back to, say, being underweight or overweight on with respect to index, and therefore playing safe. So
Right.
everyone has its good days and bad days. But I
Mhm.
mean, from an alternates point of view, I mean, because we are not constrained because of those kind of regulatory reasons, the case for alternates is better, and therefore,
Right.
I mean, over time, hopefully, PMS AIFs do much better than what, say, a typical mutual fund can deliver, and especially the passive fund managers.
Amazing. I think that's what our document also, the PMS Chronicle, which you've gone through, explicitly covers, right? The entire industry deconstructed in a form where today it's all about returns and performance is what you see out there, right? Anywhere out there on a PMS or an AIF. So what we are trying to bring in with the document also is to bring more insights on how increasingly bottom up you can be as an investor in choosing your fund as well. So, I mean, if you have any words on PMS Chronicle, it'd be great if you can let the viewers also know, Darshan, if you've gone through.
No, I
Yeah.
think I have seen the report. It's a great initiative. I
Thank
would
you.
say differentiated document versus the other two prominent ones out there.
Right,
I mean,
right.
you have to be differentiated in order to make a mark. I mean, otherwise, I mean, nobody
Absolutely.
will read a third report. I mean, just to
Absolutely.
give you a corollary example, in
Sure.
sales side, I mean, in buy side, I mean, we receive a lot of sell side reports from a variety of institutions covering, say, a prominent company. Now, obviously,
Right,
how do you differentiate is one is that you can be very fast and you can be right up. I mean, moment the
right.
result is published, you are among the first guys to send out a
Hmm.
first cut, or you are sending out the results update note, or
Right,
otherwise you be the last, but you come up with
right,
some good insights which forces buy side people to open that report.
right, right,
So
right,
because you are competing with so many other guys, you have to create differences. The same is true for even businesses. One of
right,
the our quality criteria, which is business quality, what we are trying to identify is what is this company doing differently from the rest of the sector. As an
right,
example, I mean, for example, MTAR, which we own
right.
in still own in our portfolio. Why MTAR and why not some other company? Because the components that it was manufacturing for the US client,
Hmm.
uh, hardly two or three companies in the world are manufacturing those components. They are called hot boxes.
Right.
Now, it's such a critical component that MTAR started receiving strong orders from its
Hmm.
major client, which is Bloom Energy, from
Hmm.
September 2025 onwards.
Hmm.
September 2025 was the time when US had imposed 50% tariff on India.
Hmm. Right,
We could
right,
have gone to Taiwan, but
right,
it rather gave the orders to MTAR. That
right,
in the way showed that, I mean, he was manufacturing those critical components in such a proper way that, I mean, the client was willing to pay higher tariffs in order to get those components on time and
hmm.
of the desired quality. So we,
Right,
even in our stock picking, we are constantly trying to evaluate companies and differentiate companies based on quality of business, management, financials, etc. And sometimes we may be wrong. I'm not saying that. I mean, our framework is perfect. I mean,
Right.
every it needs constant refinement. So our attempt is to constantly improve on everything, and at the same time do the same for our corporates and clients also.
Absolutely. Like you said, you get 6 to 7 ideas out of 10, right? I think you've met the gold standard, right? I think that's what you guys aspire for. I'm sure Sundaram will be able to do a great job on that front. Just a final question from my end, Darshan, before we move on to the Q&A. See, you talked about your research team being very strong, right, with respect to the entire list of schemes that you guys manufacture. So, quick thing on how it works generally, let's say a bit on scuttlebutt and how we worked on, let's say, a specific idea like MTA. If you could just make it very brief without, letting too much of the know-how out. If that could be
No,
yeah,
so I
something
mean,
on the yeah.
as a team, I mean, we have three senior research analysts, each covering specific themes. So I will take you through to that. So this is how it is. I mean, we have a steady investment team consisting of three senior analysts who cover
Mhm.
certain themes. So, for example, Piyush, he's our capital goods and pharma chemicals analyst. We have Saundarya, who
Right,
covers consumer and auto. We
right,
have Arvind who is covering our BFS and related sectors, and we have got two junior analysts and one database analyst who has recently joined. All of them doing well in their respective roles. So the junior analysts support the three senior analysts so that
right.
their bandwidth can be released. And we are of course also looking out for, I mean, also building up our team in the form of additions at a senior level as well.
Hmm.
Again, the idea is that companies go through I mean, sorry, the analyst, as and when we find a good idea, the analyst does a quick, dirty work turnaround of the company. I mean, goes through the
Right,
basic financial numbers, either from screener or some financial model from the sell side. Do a quick round of discussion with the few sell side analysts who cover, and thereafter, I mean, if we find it more interesting, we do a few round of meeting with the management, try and do a plant visit, site visit, do channel checks. I mean, it's not just about talking to that company but also talking to its competitors, right? So
correct.
talk to other players in the industry, try and see, get a sense how the industry is shaping up. Generally all of them will say similar things, and try and smartly also get some idea of what others are thinking about this company and so on. So we
Understood.
talk to the employees if possible. I mean, we may not, I mean, but our plant visits, site visits give us a chance to talk to people down the pyramid. And
Right.
sometimes we get some insights which may be more positive or negative for the company and so on. So that happens. We talk to clients, especially in consumer facing sectors. We can do our own scuttlebutt also. So for example, say in
Ah,
a retail chain, we can go to the store and do our own checks also. I mean,
right,
as
right.
we get a sense as to what the management is saying is true or not, and so on. In B2B sectors, it is about talking to experts, it's about talking to other peers, talking to employees, talking to suppliers, etc., and use every possible opportunity to see where you can I mean, do more. But so yeah, as I mean, so basically after doing all these initial rounds, then of course we do further deep dives, we see global trends. So for example, in case of MTAR, it was also, I mean, a play on the global US Bloom Energy's potential. So
Mm.
Piyush did a lot more deep dive onto Bloom Energy and what is
Mm.
the potential that Bloom Energy had. Fortunately, he was ahead of the curve in picking up the fact that Bloom Energy is set to receive very strong orders from the likes of, say, Oracle, Google, and other data center
Mm.
operators,
Right.
and that reinforced our faith. So, interestingly, MTAR was a low weight in our portfolios. It
Mm.
was at around 2.5% across
Okay.
strategy. Post our understanding and our conviction, we increased the weight. So we took it to 4 to 5, or maybe in some strategies even 6% weight.
Oh,
And
oh, oh.
therefore, I
Right.
mean, because that did very well, our
Right.
returns got enhanced significantly. But
Right.
again, the point what I would try to make is that it's a combined effort. I mean, so I would lay the strong returns that we are seeing on multiple factors. One is the effort of the previous fund manager in turning around the strategy. You
Mhm.
saw that FY 21 to 24 was a tough time for him,
Right.
uh, and that was also one reason why he had to churn quite a bit in the strategy. But
Right.
now that he had done the right thing and turned it around, from my perspective, when I took over, I did not require it to churn much. So you see, that's
Mm.
also an important thing. Sometimes you don't unnecessarily need to churn just because a fund manager has changed. So
Correct.
I retained, I would say 60-70% of the portfolio. On the balance, 20-25%, where we were not comfortable with the management or business or various other factors, we trimmed, exited at the right point in time. That helped us prevent further drawdowns in those stocks, because I would say out of seven stocks, five are still below our selling price. In two,
Okay.
three, they may have recovered above our selling price, but that's okay. You can't be perfect in all such things.
Correct. Correct.
And finally, so the previous fund managers' efforts, our continuation of the good part of the portfolio, letting go of the weaker part of the portfolio, and replacing them with some newer ideas which have went on to deliver meaningful returns. I would not say blockbuster returns like entire, but some of them are up 20 to 30 or 40, 50% also. So
Understood.
generally, I mean, that approach has helped, and we have tried to strengthen our risk part as well. So we have put some various guardrails in place with regards to weight management, percentage and the portfolio kind of weight management, having some rules and certain other quantitative filters to see if we can be more scientific in our approach,
Mm.
and trying and ensuring that not get into a good company at obscenely rich valuation, because
Right.
having that valuation discipline. So all of these factors, I would say, everybody's efforts has given this fruits right now, and it's a journey. So there will be ups and downs. So for example, July, it's right now we are underperforming the benchmark, but I
Right.
I don't have any shame in hiding it.
Yeah.
So in fact, I therefore I call it out right away that I mean, if
Right.
people are expecting that, I mean, it's a one-way journey and every month we will outperform. That will never happen with any fund. Forget us, any fund.
Right.
There will be ups and downs for every fund.
Right. Right. Got it. Amazing. Thanks, Darshan, for being very patient with your answers. Now, I think we can get to the Q&A session for the viewers. So, if any of the viewers have any questions, maybe they can type them out in the chat box, or they can just raise their hand. If once they raise their hand, Ramya, we can just, I think Mr. Jyot Kali Prasad Bogaraju has a question. Ramya, if you can maybe unmute him and switch on the video, it can be, they can probably ask a question.
Hey, can you hear me?
Yes,
Yes.
Mr. Jyot. Yes,
Okay.
please go.
Hi, Darshan and Ganesh Kali here.
Hello.
Yeah. So I have question related to your AIF offering, which is Atlas Fund, right?
Mhm.
Does it have again the same composition of stocks but different weightages, and which strategy of PMS does it mostly align with? You showed that 100% that matrix, right?
Yeah, yeah, this one. So I got your question. So Atlas one is most aligned to Voyager, you can say so.
Voyager. Okay. Okay.
So our Voyager. So basically, what happened was that Atlas was the first introduced in I think 2022 as a way to replicate the Voyager strategy on the AIF platform. So initially there was a way. I mean, yeah. So you can say it's a replica of Voyager on the AIF platform.
Voyager. Okay, got it. And just a follow-up question. I mean, if you had seen basically Sundaram is doing really good in terms of returns, either relatively or absolutely in the last 1 year or so, right? So is churn expected to happen now, given that there has been quite a bit rally in the current portfolio of yours?
Yes. So this low churn that you are seeing right now at around this, so think of this churn ratio as double. So what happens is that this data we take it from the SEBI website after when it gets published every month. So there is a monthly portfolio turnover and there is an annual portfolio turnover. So what happens is that both buy and sell transactions in any PMS strategy gets recorded as a as a uh, one more addition to the churn. So think
Okay.
of it divide by two on average, I'm saying. So
Okay.
when in FY25 it showed a 100 to 120% kind of a portfolio churn. Think of it as 50 to 60% of the portfolio was, I mean, basically new stocks came in, old
Mm-hmm.
stocks went out, which meant that 60% of the portfolio churn in a 1 year's time from FY24 to FY25. Now, as I told you, I mean, we had a tough time from FY21 to FY24, particularly from FY22 to FY24, where quality was not doing well and value, momentum, and a lot of, I would say, companies which ideally you would not want to invest doing very well. And therefore, I mean, the previous fund manager was under a bit of pressure. So, but see, the point is that how do you learn from that? And that's why he actively removed many stocks which he felt would do well, but unfortunately didn't do so. And he got this new set of stocks. Many of these capital goods names that you see currently are came under his tenure. But it's not as if I was not aware of those companies. When I took over, I was also, in fact, I also used to track MTA TD Power in my earlier setup.
Mm-hmm.
So, I mean, I was more than happy to know that, I mean, good that he had these companies, I would have also bought those companies. So, that's a good thing that we had. We had a good, I would say, meeting of the minds in that regard. And so because the churn was very high, FY25 you see a peak happening. But then
Mm-hmm.
when I took over there, because it did not require much churn at that time, so you saw the churn ratio coming down drastically. And it, in fact, it in FY27 also generally it has been around this range only. But starting in June, July, especially July, we have been trimming. So therefore, you will see some increase in churn. I'm not saying that it will go to this kind of level, but it will maybe be around this, which means that around 25 to 30% of the portfolio will see some change. Because and there is a difference also. I mean, it's not as if I'm a replica of the previous fund manager. The way I tend to be think is that if I am on the right company and if I especially got it at the right valuation, I want to hold it for as long as possible, which means that I'm willing to let certain part of the portfolio go through a time correction also, if required, of even a year, because I know that after that 1 year of a sideways movement, it may enter into a new upcycle phase also. And I cannot perfectly time the complete exit and therefore a complete re-entry into the portfolio, because you everybody has its own behavioral biases. I
Correct.
want to avoid that. That's why I'm willing to bear a pain of sideways movement in some stocks if they don't do anything for 6 months, 1 year. In fact, MTAR, interestingly,
Yeah.
post our buying for the first 7 to 9 months, depending upon the timing, did not deliver any returns. We had bought at 1800. In fact, in the lows, it had gone to 1400, and it was around this 14, 15, 1600 till September. After September till November, mid November, I would say the stock rallied 80%. Then it again went through a time correction of another 2, 3 months. In fact, it corrected by 11% from that time. Then it has been on a stellar run of almost like 150 to 200% return. Now it is going through another down phase where it is down 20% or 25, 30% from the highs. So the point I'm trying to make is that every stock will go through ups and downs. There will be time corrections, there will be absolute price corrections. But I mean, unless you ride that pain, you are losing out from the eventual very long term strong return. I was not in Sundaram, but I'm sure many other funds would have seen that they had bought Bajaj Finance in 2010-11 at 5 rupees and today's price. In the next 3 years, it went to 25 to 30 rupees. So it delivered 5x, 6x kind of returns. But after that, I mean, you may have feel that, oh, I've made a lot of money, let me exit it. You missed out on the next 30x return eventually over the next 10 years. And those 10 years, Bajaj Finance did go through periods where it did not deliver returns, or it corrected, or it even went through multi-year correction. But unless you are able to ride that patiently, you will miss out.
Yeah.
And very honestly, I can tell you, nobody tends to rebuy once they've completely exited. I mean, very few fund managers or investors have the strength and the willingness to rebuy the stock which you have exited again. I mean, I
Right.
obviously want to do perfect that, but I'm not currently at that juncture.
Yeah, yeah. Actually, this reminds me of quotation that for a stock to become a multi-bagger, you should let it become one, right?
Exactly.
Absolutely.
And See, one more important thing is that like, when we bought MTAR TD Power last year, honestly, we did not know that they would become like this. I mean, we bought them with a view that they are good companies, good quality companies, available at reasonable valuations, very niche, less competitive in companies, and available at reasonable valuation. Now, reasonable valuation is again subjective. We use ratios like PEG ratio to figure out if the company is cheap. MTAR was a 30 P at that time also. But at least we knew the earnings growth would be very strong. So PEG ratio wise, we felt it was at around 1 time. Then that once the order inflow started to happen, the order book became very strong, execution picked up and everything. The earnings growth saw upgrades and the future earnings growth became non-linear. From 100 crores PAT in FY26, the earlier expectation was that it would be 250 crores in 28. Suddenly it became 300 and today people are calling it out as say either 400, 500 crores. Various consensus estimates or even buy side estimates differ, but the journey from 100 to 400 is a non-linear. So on a PEG ratio, even now it is at less than 1 P, 1 PEG. But I mean, so you have to be a bit subjective also. I mean, even though on a PEG ratio it looks cheap, but on absolute P multiples it is at 50 times. So whether MTAR deserves 50 P, it's a question only time will tell. Whose answer only time will tell.
Got it. Yeah, thanks, Darshan. The presentation was really insightful and your thoughts also. The question that I primarily asked also because of MTAR only, because it's part of your portfolio and in the last 1 week it corrected quite a bit, right? So that's why I wanted to hear your views.
Absolutely. And so see, while we have trimmed it from like in one of our strategy, it had crossed 13-14%. We trimmed it down to 7%. In another strategy, it was 10-11%. We trimmed it down to 7%. But thereafter, I mean, we remain very convinced. So that's why we have not exited. Now, and therefore, we are willing to bear the near-term pain.
Makes sense. Yeah. Thank you.
Thanks, Kali. Any other questions from the viewers? If you guys can raise your hands, we'll enable your mic as well. Any questions, you can raise your hand and we'll enable your mic so that you can ask your question. We'll just give it a minute, Darshan. If there's nothing from our viewers, we'll conclude the meeting.
Sure.
Yeah, I think I mean we're done with the questions as well from the viewers end, and I think we can conclude the meeting right now, Darshan. Thank you everyone for coming on a Saturday morning. I think it's we usually prefer Saturday mornings to be a little lazier than this, but then I think it was a pretty heavy presentation, but a very insightful presentation from Darshan. And thanks a lot, Darshan, for being very, very patient with all our questions and with the entire presentation as such, because it was a heavy one. I think you went a little full throttle on the presentation as well. I think that's something that we would really appreciate, and our viewers also would appreciate. Thanks a lot for giving your time, and hopefully we get to do good things with the products that Sundaram comes out with. Yeah.
Sure. Thanks,
Sure.
everyone. Thank you so much, Ganesh and team, for inviting me. And I knew the presentation was a bit heavy. I hope it was useful to all of you. And
No, heavy in a good way as such, Darshan. Yeah, I think it was heavy in a good way. Yes.
so, yeah, and I hope I've been able to cover a lot of ground and a lot of hopefully able to answer your questions as well as viewers' questions. So, if there are any more questions, you can always drop an email to Ganesh and team, and they can forward it to us.
Yes.
On
Yeah, our contact us. page is also on the screen right now. If anyone wants to let us know what, if any questions or any queries, you can just reach out to us, and then we'll get back to you as soon as possible. Yeah.
Thank you so much. Bye bye.
Amazing. Thanks a lot, Darshan. Thanks, everyone. Thanks.